The Taxpert Pencon tool 2020-21 includes all of the calculations that you need to advise clients on the optimum strategy for making pension contributions, or in some cases, the amounts on which they're going to have to pay tax because of the membership of a defined benefit scheme. The user guide, which we're looking at now on screen, says first that input cells have yellow backgrounds. We'll have a look at the inputs in a moment, but please note this. Remember GIGO, garbage in, garbage out. The results from using the tool depend on entering the pension savings data correctly. Putting data in the wrong data input cells will give the wrong answer. And I've put that there because it is quite complicated to work out what figures should go where. And just before we look at the input cells, let me just have a look at the final tab, and that is the HMRC Income Definitions tab, which I've simply cut and paste from the HMRC website. But they set out the detailed calculation of adjusted income and lower down threshold income. And of course, I pointed out that the adjusted income limit increased to 240,000 at the start of this tax year, and the threshold income figure increased to 200,000. But it is identifying what those figures are made up of that we can now look at when I look at the inputs page. And on the inputs page, you can see all the yellow cells that we might or might not fill in. I've also included two columns here. First, the tax return entries column, which simply cross-references the figures into the self-assessment tax return. And one problem here for agents and their clients is that the tax return doesn't in fact include a huge amount of detail of pension contributions. Box 1 of the normal tax return, page 4, is where we put in the grossed up taxpayers' direct contribution payments. Box 2 is where we put gross payments that are paid gross into direct contribution or money purchase schemes. And then the only other box in the main return is also box 2, where you put the gross money purchase contributions if there are any paid by the employer. But then there's nothing else until I get down to here, and that's in the additional information pages. Page 4, box 10, is the hugely important box where we have to put, if there is one, the annual allowance excess charge. And at the end of last year, HMRC wrote to pension scheme trustees asking them to remind members that they do need to complete box 10, and that they're aware of the revenue, that many don't, and that those that do are completing it incorrectly. Well, we'll see how we get to that box 10 figure as I go through this demonstration. But then the other column, the notes, help you to get the correct figures in the right place, and it'll take a little while for you to work out what goes where, but it's a key part of coming up with the right answer. Originally, by the way, this was devised purely to look at the brought forward unused relief available. We can carry forward unused relief for 3 years, but like so many things, it's grown like topsy and is now a very useful tool that covers all sorts of different areas, as we'll be seeing later on. Well, I've already pre-populated some of the data. We've got earnings here, quite a high income individual of 130,000, 147, 173. This could be a director shareholder of their own company. They've got other income, might be rental income, 12, 13, 14. And yes, they are members of registered pension schemes in each year. That's important because it affects the carry forward. There's a drop down box. And actually, if you just look at that annual allowance figure down at the bottom, 40,000, that's assuming that they are a member of a scheme. If I change that to no, you'll see the 40,000 disappears, because if you are not a member of a scheme, then you don't have an allowance, and that means you can't carry any forward. So quite important that we know that. And then I'm assuming here that for the last couple of years, they've been paying the equivalent of 1,000 gross into a personal pension, so 12,000 each of those years. I'm not yet looking at what we're paying in 2021, but I am estimating the income for 2021. And then we've got the total pension input amounts. We'll come back to the other yellow boxes later. And you can see here the annual, oh, that's interesting. The annual allowance for 1920 is tapered there to 35. And that's because the threshold income and the adjusted income breach the limits, and so we have a tapered annual allowance. Whereas for the current year, on the proposed figures, there is no breach, and that's because of these in each of the threshold and adjusted income figures. So that is an interesting point to begin with. But this section, for those of you that are familiar with it, the MPAA is the money purchase annual allowance. And if that has been triggered because the client has flexibly accessed their pension beyond the tax-free lump sum, well, you see that that restricts the allowance to 4,000 in respect of any direct contribution scheme. So that 4,000 allowance is restricted, although there would have been brought forward allowance as well. And that's another complexity that the app accommodates. But beneath that, very important, these three yellow boxes here, you must input from your files any unused allowance as at 6th of April 18. So that's from the 3 earlier years before 1819. Just going back up to the top, you can see I've got input figures for 1819, 1920 and 2021, but we need the history. So for 15, 16, 16, 17 and 17, 18, was there any unused relief as at 6 April 18? And you get those figures from file, and yes, those are the figures there, and they then will feed into these three columns here. We've got unused brought forward of 28. I'm sorry, that 28 is the unused allowance for the current year. The brought forward is the 34.5 just above it. We don't use any of that, and so in fact the first of those years will expire. The 12,500 there is unused, and so we can only carry forward 50,000 into 1920, and so it goes on. And then here you can see the payment allocation. So if we paid 12,000, that's been allocated to its own year naught allowance and hasn't used up any of the brought forward. We'll see those figures changing as I change the input data. And then right at the bottom, total allowable. I've also included, because it might be an interesting planning point, the minimum additional premium that the client could pay if they wanted to avoid wasting any of the brought forward that is about to expire. And so we know that 12,500 is about to expire from 1819. Well, if we had paid, in fact, the maximum, well, we would need, to pay 40,500 to use that up, that being the 28 of its own year plus 12.5 of the brought forward that's about to expire. And then another useful figure here is the minimum that you would need to pay in order to avoid the tapering of your personal allowance. So for some clients that might be useful in terms of maximum tax efficiency and getting tax relief at the highest rates. And then just to clarify that point, you've got the adjusted net income for that restriction, which at the moment is always going to be 100,000 more than the figure that we've got here, because 100,000 is where the taper cuts in. Well, one of the problems that we have come across more recently is where the individual is a member of a defined benefit scheme. It could be a final salary scheme or a career average earnings scheme, and where this generates significant amounts of pension input amount or pension savings. And these figures will have to be notified by the pension scheme trustees, and we'll then include them in the calculation. Now let's have a look at what happens if this individual is a member of an employer's scheme, perhaps a final salary scheme or a career average earnings scheme, and we've got a pension input amount. Well, let's suppose back in 1819 it was 23,000, and maybe in 1920, the year just ended, it was 38,000. And I'll just pause there. We don't know what it's going to be this year. These figures, by the way, should be notified by the pension scheme by October following the end of the tax year. So you won't yet have the 38,000 for 1920. But what happens when we put those figures in? Well, I can see straight away here, if I go down to this box, for 1920, I'm going to have a figure to put in that additional information page, box 10. £12,000 is the excess, and this is for somebody that had quite a lot of brought forward allowance. But what has happened is that the 38,000 pension input amount has reduced their annual allowance for the current year down to 16 because of the taper, and they've used up all of the available brought forward, as well as all of their available current year allowance. Their total pension inputs are, by the look of it, 50,000 for this year, and that's in excess of 12 over their allowance. But then if I do a similar thing for the current tax year, let's suppose that it's 42,000, then because there's even less by way of brought forward, although in fact the taper is not quite so bad because of the increase in the limits for the threshold and the adjusted income, again, I've got an annual allowance excess charge of 2,000. So those are the figures that would have to go on the tax return and on which the taxpayer would have to pay tax at their marginal rate unless they ask the pension trustees to pay it for them under the so-called scheme pays facility. But let me have a look at a couple of other sheets that I've included in this app. And this you might find particularly interesting. It's the defined benefit pension input amount estimator, bit of a mouthful, but what I've done here is give you the ability to estimate what the pension savings figure might be if your client's a member of a defined benefit scheme. And as usual, it's the yellow background cells that we can input. The employee contribution rate, well, if this is one of the NHS schemes, that could be as high as 14.5%. The opening pensionable earnings, you'll need that information from the client or from your records. And then the pensionable pay rise, let's suppose we've got 5,000 as the increase in those earnings over the year, a very modest increase. And then you need information from the scheme itself. There may be an accrual rate denominator of 60, and that means that you accrue 1/60th of your final salary, if this is a final salary scheme, for each year of service. You might have a lump sum figure as well on reaching retirement age, and in this case it's 3 times your pension. And then if you've had 20 years of service at the end of the year, that goes into it. CPI to last September was 1.7. There may be an inflation supplement. So we need to input those figures, but then look at what we've got. 47,088 is the calculation of the pension input amount for a very modest pay rise. And you can see here how these figures can be very significant. If, for example, there was a grade increase together with some overtime of, say, 20,000 instead of 5. In other words, the income goes up from 100 to 120,000. Well, when I press return, have a look at what happens to the 47,088. Wow, it goes up to 142,088. And if I then feed that back into the input figure, let's go back to the input tab. Suppose that's this client, instead of 42,000, we've got 142,000 this year of their pension input amount. Well, that will give them an annual allowance excess charge of a staggering 102,000. And I noticed there that their annual allowance is still 40,000, so they're not being tapered. And that's quite interesting. Their adjusted income does include the pension input amount of 142, but their threshold income doesn't. And even at 187, the threshold income is below the increased figure of 100, no, what was the increased figure? 200,000, wasn't it? So they don't get subject to taper. This does, by the way, indicate that what the government have done in the recent finance bill from the March budget by increasing those threshold income limits and adjusted income limits is not going to help this sort of taxpayer where they still have very significant pension input amounts. So what they've now got is 102,000 on which they've got to pay tax at 45% for somebody in this category of income. Well, that tax calculation we can see in one of these other windows, tax calculation here, and you can see the 142,000 pension savings, the net income and so on, and the tax on the excess charge looks as though it's going to be 45,900. So a huge amount of tax they're going to have to pay on that additional income. Remember, they were looking there I've got slightly different earnings figures actually, but never mind. The extra income was only 20,000, which has generated that tax bill. Now, this is where scheme pays comes in. And if you want to advise them, you can put in the pension input amount figure for this scheme, which was 142,088. It's already picked up the tax charge, and this then works out how much you can require the trustees to pay. That's the mandatory scheme pays. In this case, it's all of it, the 45.9, and how much you can ask them to pay voluntarily. And it's another complication. That, by the way, does then go in the scheme pays amount in box 11 of the SA 101, and that's how the revenue will then know that they don't need to include that in the payments that the taxpayer has to pay for that tax year. And then the final thing to show you is the client report. It is a hugely complicated area. So the client report is relatively simple. It shows for 2021 the earnings, the other income, giving the total income, the total pension input amounts. Well, here we didn't have any direct contributions. It's purely the money purchase figure of 140. I'm sorry, it's purely the defined benefit figure. If it's an NHS scheme, it'll be from the NHS scheme trustees, 142,000. The available allowance is 40, so there's no unused in this case and no taper. So the annual allowance excess charge of 102. Minimum required to use the brought forward amount to expire, none, because there is no brought forward left. And the minimum to retain the full personal allowance, 87, but this would be if you were paying it as an additional contribution, but you're not going to. And the estimated tax on the excess charge, that's staggering £45,900. Well, there it is. As I said at the beginning, the key thing here is to get the input figures correct. There are various points I've not had a look at, net pay contributions, employer money purchase, I think we did touch on, but these have all been very carefully devised in order to come up with the right answer and make sure that your client is not one of those who gets picked up by the revenue for not accurately completing the excess charge figures, and also that they do use to optimum effect the annual allowances brought forward as well as the current year.